Welcome to another edition of View from the Ranch, the October edition. I'm here with my business partner and Chief Investment Officer, Brad Tremitiere, looking handsome as you.
Oh yes, as always, Greg. Not nearly as attractive as you with your flowing locks, but
well, you know, not.
I got mine high and tight yesterday. I had to get that haircut in right before the government shut down. So
yes, good thinking.
I'm feeling good. They
Good
can stay
thinking.
closed for at least another month and a half before I have to go back to the beauty salon.
Well, let's jump into it now that you mentioned it, right? The major headlines for today all over the news is the dreaded government's shutdown.
Oh, no.
And how we should all cancel plans and the market's going to crash. Is this something to be worried about? Is it just another non-event as usual? What's your take on it, Brad?
I guess if you're a government worker that could potentially be furloughed, it would be something to be concerned about. Other than that, it doesn't really mean much to both the general public as well as the market. So the shutdown will basically cause the government to pull back on non-essential activities, furlough non-essential workers. Of course, everybody in Congress is essential, so they'll keep getting paid and keep getting their benefits. But it really doesn't mean much to us. And it really doesn't mean much to the market. So
is it more just like a bargaining tool?
It's
right,
exactly, both sides using different leverage to get what they want.
Mm-hmm.
So
And then they bring that out to the media and the big headlines to scare everybody.
yeah, I mean, they gotta sell ads. So they'll keep having every congressperson on and sit there and tell you how the world's going to end because the government's going to shut down. Doesn't really mean much of anything.
Well, I think from an investor standpoint, that's what we want to focus on. Is it something that investors may experience some short-term pullbacks or something more severe? Or what's been? I know you put a lot of studies into it, and what is historically, what have the markets done
on average
during a shutdown?
Just looking at the shutdown since 1980, and looking at shutdowns that last more than a day. The average returns for the S&P during these shutdowns is positive. It's up on average about 1.42%. And then once the shutdown's over with, the 3-month average return for the S&P is close to 4.5%. So it has a little bit to do with the calendar because since the fiscal year for the government ends in September and it starts in October, the market tends to be moving into that better part of the calendar. But what we have seen over the last 4 or 5 shutdowns is just infighting between left and right.
Okay,
basically about it. It's theatrics. This time the Republicans passed what they would call a clean funding bill, but Democrats are pushing back on the Affordable Care Act, enhanced tax credits or tax benefits that were put in place back in 2021, as well as some other things that were taken out of the healthcare space with the big, beautiful bill. Very similar to what we saw 2013 when Republicans tried to battle the original basis of the Affordable Care Act. And, they need to just pass a short-term funding bill so that they can work on this. And that's all we really need.
what's the Republicans doing as far as changing some of the tax credits that?
Nothing. What the main argument is on these enhanced tax credits, tax benefits associated with the Affordable Care Act. These benefits were instituted in the American Rescue Act in 2021, or the second CARES Act from COVID. They expire at the end of this year. The Republicans are letting them expire, whereas the Democrats want to extend it because people need those benefits. One thing that we have to be cognizant of is now that COVID's over, we've been away from it for 5 years, we can't still keep treating parts of the economy as if COVID's still an issue.
Gotcha. Yeah. And that's always difficult when you're making a change. If you've been receiving something similar to the student loan payments when you had all that time off and now all of a sudden you have to pay student loans again and everybody's upset about that. But before there was even an issue of the government suspending things, everybody was used to paying the student loans, and you got a student loan. You knew you were getting a student loan, and certainly changes is always difficult for people, but
but at the end of the day, shutdown means nothing.
Yeah. So ignore the headlines.
It's totally different if we're talking about the debt ceiling, which we don't have to worry about for a while now.
What's the difference of the debt ceiling and the government shutdown? Like, what should people know about that?
The shutdown basically has to do with government funding the government to pay the employees, to pay for different things within the government. Debt ceiling has to do with basically every economic part of our economy. Okay. So the first issue would be not being able to pay our debt. So if we don't have the ability to continue to issue debt, then a default's going to occur. Okay. And there's excessive measures that the Fed and the Treasury can take. But if we come down to a point where we ever hit the debt ceiling and we don't raise it, then, a default would be
disaster.
It would, for the entire global economy.
And this is not that. This is
not in the least. Not in the least. Okay. You don't even blink your eye at this.
Yeah. Because I think they try to make it seem like it's similar types of headlines to scare people.
The problem with most people in Congress, it's always a chance for them to politic for themselves. Okay. It's always about them much more than it is a lot of times about the people that they represent. So, and they're worried about their next election.
Okay. So September was a good month, pretty decent month for the stock market. Again, you last month when we came on here, you said there were some very bullish indicators, which seemed to play out nicely. It was, I read a headline of one of the best Septembers in a long time. What was the return of the S&P?
Roughly about 3.5%, which would have made it the strongest September we've seen since 2010. So in about 15 years. And it was stronger than what we expected. We kind of expected, for as strong as the previous 3 months had been, that there's a chance that September could be down slightly to, up slightly.
It's historically the weakest, and so you always have that just seasonal effect. But the bullish indicators that you were discussing last month seem to override that pretty nicely, which is great.
And it helped, which we'll get into the Fed in a little bit. The Fed rate cut helped as well, and we did get some data from the inflation side of the economy, especially from the producer price index, that was much different than what we saw in August. So the idea that tariffs is causing inflation really isn't showing up in the economy yet. And at this point in time, who knows if it's going to show up? Because when we look at producer price index, the value of those goods that come in initially get, made into whatever they're getting made into, then sold to customers. Any increase in cost is not getting passed on.
Companies are absorbing it.
So the fact that inflation, after us being told it's going to come back, hasn't shown yet, which it still may. The Fed, being more dovish, and good numbers, good earnings. We have to look at the global economy because the foreign markets have done very well this year for the first time in, 20 years maybe. Yeah. So they've been kind of the leader that's been pulling us along. So as long as the foreign markets remain strong, we're going to play catch up.
And they're up over like 20%. A lot of them, which is, I can't remember in my career.
It won't last. It won't last. But for now, it's a positive.
Potentially, yes, it is good. We'll take it. That's going to help. And with the S&P being up, and then the market being up over 10% going into October, you shared that that's also historically been a pretty good indicator as well.
Last year, we could look at 15% because the market was stronger. This year, it's not as strong through September. We're up 13% and change or so. Going back to 1970 and looking at all those markets where we were that strong, we're up more than 10% through the end of September. The forward returns for the rest of the year are very, very good. The year's always ended positive, and there's been very few years where that last quarter is negative. There's 3 of them that are slightly negative, and then we got 1987, which was a disaster from the crash of 87, but it still remained a positive year. So moving forward, October tends to be the weakest. When we're this strong going in October, it tends to be the weakest of the 3 months. But then the strength that we don't have in October grows through November and December.
Okay.
And
real quick, 87, it finished up. I didn't realize.
Yeah,
that.
2%.
Is that
2%.
right?
Even though it lost 30% in the last quarter.
Wow.
Still finished up 2%.
Imagine all the people who sold, panicked.
Yeah, if you could sell, because it was a different time. They couldn't make bids in the market. That's why everything kept crashing.
Another lesson to not panic as best you can when something like that occurs.
And looking at the seasonal side of it, we're in a post-election year, and since 1985, there's been 10 post-election years. The returns for the fourth quarter have been extremely good in post-election years for the market, and that's what we're turning into right now.
So it sounds like you're still pretty optimistic, and although of course there's concerns there's always concerns to deal with. Jobs, for example, were not very strong recently. Just keep kind of downgrading and revising things.
And we talked about that last month.
Yeah,
they have not improved yet, but that's going to be part of the process. It's nice that the Fed finally recognizes it. There are issues with, a lot of government jobs have been removed, and you have some general softness across the economy as far as employment goes, but it's not so much showing up in the weekly data. So we're getting weekly jobless claims and continuous claims that aren't really out of control. So
aren't a lot of those government jobs are still getting paid for a year? Did that happen?
I don't know, but it's an unwinding of what the excessive hiring that took place the last couple of years. So
I wonder how many people took advantage of the offer to.
I know there was 100,000 people that resigned yesterday based on previously accepting offers.
Okay.
So I don't know what the terms of their severance is, but if we can get the price that we've got to pay to employees on the government side down, it's going to help the overall strength of our economy, because we have been overemployed on the government side now for the last couple of years.
Yeah. Based on historical averages, it certainly grew over the last 4 years tremendously, or before this year. And so the Fed came in, cut rates in September. A lot of people were hoping for 50. They dipping their toes in at 25 basis points, but they indicated that there might be 2 more cuts, perhaps.
It was really their report, or their data of what each voter inside the Fed. It was very strange, because you had some dissenters. You had a couple people that thought they may need to raise rates, but the overall tone was much more dovish than what we've seen. And they go back and talk about the changes, or the weakness that we're seeing in the labor markets now, which they did the special revision too, the annual revision a couple weeks ago, which took out like another 900,000 jobs. So they're finally realizing that the the labor market's not nearly as strong as they thought it was the last year. And that's important, because that's one of the 2 major components. So if we're not having full employment, at the same time we're not seeing inflation, that's a perfect environment for the Fed to become more dovish. So they cut a 1/4 point. They should have cut more. They still need to cut more. They have a meeting at the end of the month. Right now, it's probably 95% for them to another 25 basis point cut. Then there's another meeting earlier in December, which they expect to cut again. So the 3 rate cuts are on the table. The market is expecting it. If we don't get the 3 cuts, we'll probably be disappointed and give back a little. But seeing how the labor market is softened, I don't think the Fed has a bunch of things to worry about right now.
Now, is the real estate market, housing, rental prices, is that offsetting some of that inflation?
Well, you have to look at the CPI, the Consumer Price Index, that comes out second week of every month. A large portion of that's made up of shelter, which is homes, rents. That year over year, growth or deceleration in price tends to lead the overall consumer price index by about a year. And we continue to see rents and anything that has to do with shelter, inflation is starting to drop. I mean, we've seen it here in Sarasota, where the average price of a house has come down rather significantly from where it was a couple of years ago. So,
and rents.
Yeah,
too.
that since it's such a large part of your monthly expenses, that coming in will help offset any tariff inflation that we may see, which I still think is not going to happen that much. So we should be in a period of better inflation data, which again the Fed can lean on to say, let's get back to a point of more neutral than being so tight as they've been for the last 2.5 years.
Yeah,
and they're finally going to stop their quantitative tightening, which
help explain that. I don't think a lot of people look at that or know what it is on a basic level of what have they been doing to quantitative tightening and what's the shift in that.
Well, during COVID, we were buying $125 billion of our own debt each month, as well as mortgage securities, so treasuries and mortgage securities. The Fed buying those bonds basically leaves that money back in the economy to be used in other areas. It's another form of stimulus. When we can't take interest rates below zero, we buy back our own bonds, which adds more liquidity to the market.
Builds up the Fed's balance sheet.
Yeah, and the balance sheet,
enormous.
Quantitative easing went on for way too long. Should have ended at the end of 2020, but it kept going all the way to March of 2022. Then they shifted gears and started tightening, which means they started anything that would mature on their balance sheet, they would start rolling it off, meaning that they would, on the new issues of treasuries, they would put those out to the street to buy them up instead of the Fed being a buyer. And that takes money out of the market or out of the economy. We've been rolling off the balance sheet. It's decreased. The roll-off size has decreased, but it's still rather large from what we were looking at in like 2018. And it still acts as a tightening policy for Federal Reserve, which is what we don't need. My opinion would have been that they should have stopped QT before they started lowering rates and then began lowering rates. This idea of lowering rates but keeping quantitative easing in place doesn't really make too much sense. So bank reserve levels are back down to where they need to be. So it's about to the point that quantitative tightening isn't doing any benefit for anybody anymore. So as a policy mechanism, they should stop rolling off their balance sheet and keep reinvesting the maturities that they have. It would add some liquidity to the market without the Fed maybe having to be too aggressive in cutting rates and, upsetting some people.
So now they'll be doing two dovish things if they're cutting rates and ending their quantitative tightening.
The Fed just needs to stay out of this stuff. I mean, since the great financial crisis and TARP and then learning of what we needed to do to get things moving again as far as credit goes, we've lived in this period of quantitative easing. We tried to get off it till COVID came, and then we've been back on the boat, whether we're easing or tightening. It'd be better off the Fed, government just stayed out of it so that a lot of companies could better manage their balance sheets. I don't think it will happen. I think we're kind of stuck in a period where we have to keep doing this through good times and bad. So, but ending it will definitely help add liquidity back into the market and keep things moving relatively smoothly. The Fed, 2 more cuts this year, probably. It's almost 100% they're going to cut in October, see what they do in December, and then get an idea of what they're looking at for 2026 when there's going to be a new Fed chair. So there'll be a lot of interesting things occurring.
What do you expect these cuts, what do you expect of how they're going to impact like mortgage rates? I think what a lot of people are wondering is
we've seen mortgage rates come down.
Starting to see some more transactions. Really, in our area, it seemed like there wasn't many transactions. Hurricanes might have had, everybody was scared of a hurricane, might have something to do with it, but certainly borrowing at over 7, and now if it's around 6 or if it gets in the 5 handle, you're going to start seeing some refinancing. You're going to start seeing, I think, people who are kind of on the sidelines waiting for rates to come down. So that could be another plus of things, as long as it doesn't get too crazy like it did after COVID for a little while. But it seems like we're getting back to that regression to the mean of where prices should be, and although they're still high, but
the interesting looking ahead, the interesting thing I'm trying to process is that second year of the presidential cycle is always the worst year.
So 2026 would
be,
yeah.
But it's also predicated on the post-election year being a honeymoon year, then all the hard work getting done in the second. Trump's done a lot of hard work already. I don't think there's anything left that we don't know about that he's going to be involved with. So it kind of takes away what the catalyst has been for the market to run into some volatility. Now, if we look at mortgage rates and people being able to refi at lower rates and save money each month, it will unlock a massive economic tsunami. People could save $1,000 a month. That goes a long way to helping out the economy. So lower rates is going to unleash a lot of growth potential. And we'll talk later in a couple months about the massive amount of tax returns that people are going to get next year because of the new tax bill.
Tax benefits? You mean?
Tax benefits. They're estimating tax return to individual taxpayers is going to be 50% more than what it was this year. So it's going to be a $200 billion stimulus that's going to go into the economy just from tax returns.
Especially if you're a waiter or waitress, tax-free tips. I don't think a lot of people understand how much that is going to benefit a lot of people.
But for next year to be a negative year, there's got to be some other, I don't say black swan, there's got to be some other event that comes out, because right now it looks like growth wants to start getting going again. And once we can have people get money, save money from mortgages and the amount they're going to get in tax returns, as
refunds,
well.
You mean?
Yeah. And refunds and other areas, that declining, savings rate that we've seen in personal spending is going to improve pretty significantly.
Although I'd say the only offset to that, or at least it'll help tremendously, is if someone has a student loan and now they're paying that again. That'll be at least neutralize it. Hopefully that it's not an increase. You're just getting an increase in your student loan payment, and now you have less spending money, because spending is the economy, right?
Yep.
And we seem to still be able to spend, not as much, of course, as after COVID, but when everybody had a lot more money and free money, but still the economy seems to be doing well, unless the job situation worsens. But if businesses start getting more confidence,
we're not getting the numbers. I mean, we're not getting the weekly numbers on continuous claims and weekly claims that would get us to a point to be excessively concerned about job numbers blowing out. I think they're kind of getting back to a mean area and getting corrected because of what we talked about before, of how strange the Bureau of Labor Statistics counted jobs the last, how many decades. It just doesn't work as well as it used to.
So let's talk about the markets, specific areas of the markets for a minute. Certainly the last few years, or even more, the big tech and just a handful of companies have led the stock market. What's the situation like going into like this year from like outside companies, from the big NVIDIAs and Metas and Googles of the world? Is that starting to broaden out? Are we seeing more of a broad, or is it still?
It has stops and starts. We've got to be thankful for AI and data centers and semiconductors, because they've really been able to bridge the gap on any weakness that we should have expected the last 2 years. Just the amount of growth there, the amount of spending, the amount of investment has really been able to pick up the weakness in other areas. So it's just frustrating, because every time we think things are going to broaden out, they get to a certain point and then it stops.
So there's been more stop and go. Although small caps have started to. Small
caps have finally improved. They finally hit a new 4-year high, I think, the other day. And normally when small caps, they go through these periods of 3 or 4 years, round out a bottom. Anytime they make a new year high, it's usually a pretty good indicator moving forward that they're going to finally have a period of outperformance, which small caps and international have kind of been the same the last couple decades as far as their performance versus the S&P. So there's an expectation for them to start to outperform, which would come from lower taxes that we're seeing and lower interest rates. Right. It's difficult for a lot of companies to be able to manage expectations when they are dealing with tariffs. They're dealing with the Fed being unknown about what they're going to do moving forward, and potentially could be paying higher taxes. That tax issue's gone away. Interest rates are coming down. Tariffs, there's still going to be some issues there, but they don't seem to be as nearly as bad as they were forcing us to believe, 3-4 months ago.
Mm-hmm. All the tariff experts.
Yeah. So it's good if we can get the small and mid caps moving back.
Yeah. It's something to think about in your portfolios or your retirement accounts through work. If you've been very heavily concentrated on the large caps, because that's really where all the returns have been, is maybe trimming a little bit and rotating a little bit into small caps or international. I would favor small caps a little bit more than international, but they've lagged so much, and it's interesting to see how they're picking up strength. And certainly from buying a large cap company that's at an all-time high versus these small caps, which have not taken forever to start moving, to me, that seems like a pretty interesting buying opportunity to at least consider.
They've got some tailwinds that are there now that haven't been there for the last, I don't know, decade and a half, 2 decades. Let's see if it continues. But there's other areas, consumer staples, real estate plays, healthcare up until 2 days ago. They just can't ever keep going. They have stops and starts. We talk all the time about some of these consumer staple names, which yield 5, 6, 7%. Stock can't go anywhere. So when's that point going to be to step in to buy those companies? We haven't seen it yet. Are we getting close? Who knows? But
well, it's been the cyclicals, right? The financials and consumer discretionary. And so people have left out the utilities, consumer staples, and healthcare. I think healthcare was negative on a year-to-date performance.
And that's a great example when you hear people talk on TV or read something about how bad valuations are. Sure, there's a lot of stocks out there that are trading at massive earnings. But go to some of the U.S. car makers, not Tesla, but some of the U.S. car makers, go to some of the consumer staple stocks. I mean, here's companies that are trading at extremely cheap earnings with excessively good yields, great valuations, but the market doesn't lift them up. They're not getting investors. So you can say they're great valuations, but they can keep going lower, where something could be too high of a valuation and it keeps going higher. It will matter at some point in time. It's just when. So I always think that valuation is not a great gauge of the market, simply because if you've got liquidity, those valuations can keep going, and we've got liquidity.
Right. Yeah. And it never hurts to, we are really big into trimming or adding a little bit to positions. So maybe trimming some of your large cap growth stocks, although I think long-term, of course, they're going to still do great. But from a trading standpoint or investment standpoint, is buying a little bit at a time into these more moderately priced, better valuation companies, blue chip. You're not going to get hurt. I mean, there's so many great consumer staples that if you were nervous about being in the market, they're great places to dip your toes in.
And maybe they come a play next year when 2026, if it turns out to be the year of the consumer. There's a lot of value there. It has to. We technically have to see things start to turn, though. It's just been years of lower highs and lower lows.
Yeah.
Never able to sustain anything worthwhile.
But if next year is more difficult just because of just the second year term, and who knows, but a lot of these consumer staple defensive utility stocks that have not skyrocketed like the other, I would assume there's more cushion in there for downturns.
Oh, and they become more attractive when interest rates start to drop too.
Yeah.
But again, that hasn't mattered yet. At some point it will. We just got to get there first.
Well, let's talk about the interest rates coming down, and if you have bonds and fixed income in your portfolio, or you're a moderate investor and you have a percentage of your money in bonds, they're starting to produce some decent returns in addition to the coupon that they're paying. And in the small, intermediate, long term, both in the corporate and treasury, some of them are high single digits, and the price of the bonds are increasing in addition to the interest rate or the coupon that it's been paying. If they keep cutting rates, might not be a bad idea to have a little bit larger exposure to bonds. If you're not expecting great returns, but at least to me, it's like more of a higher probability of achieving a decent return on bonds. You're not going to hit home runs, but the single seems pretty attainable unless inflation comes in, they have to start raising interest rates, which we don't really expect.
We were looking at recession odds that were much larger, I guess, a year and a half, 2 years ago. And the idea of owning treasuries was more attractive because they had the best yields we've seen in a decade or so, and the belief that they would do well during recessions. Recession hasn't come yet. And I think if we don't get a recession here shortly, because of the consumer stepping in next year, it's going to be hard to keep thinking that it's going to happen.
Yeah. When the data changes, I think there's a lot of data a year ago that was concerning us that, hey, historically recessions have come when these data points have hit. And again, it's all probabilities, but the market seems to be ignoring all those data points and things are getting better. And are we in the no landing or soft landing call now?
If you look at like credit spreads between, higher yield and higher risk bonds versus treasuries, they're all at multi-year lows. You're going to see credit spreads blow out or go up if we're running into a big economic issue. We're just not seeing it. Credit spreads blowing out were a big thing during the great financial crisis 15 whatever it was years ago, 17 years ago. We're not seeing it. So the credit markets are staying relatively tame, which is the best indicator that we can use right now.
Yeah.
So it looks like, I don't want to jinx it, but it looks like for now we may have been able to bridge any of the weakness that we thought we would have the last couple of years because of the excessive amount of interest rate or Fed increases, as well as $95 billion a month of quantitative easing most of that time. Pretty incredible at the end of the day.
Yeah.
Still not there yet. Could obviously happen, but the data continues to be good. And one of the things that I wrote down when we were putting all this together was we just gone through what should have been some difficult years, as well as the most difficult period of the calendar. That sell in May going away, but obviously August and September are the worst. And August was good. September was even better. And when we're going through a period where you have this bearish seasonality and it just doesn't show up, it's a pretty big bullish indicator that there's something else out there that is very positive.
You have to pay attention to it. Yeah, you have to pay attention.
Especially in August and September. Could it be, you could say same thing about 1987, and then everything happened in the middle of October, and we got
that's more of that black swan.
Yeah,
though. I mean that can happen whenever.
Different place, different time, especially with technology and the understanding of different derivatives and futures and options. But right now, everything we're looking at looks pretty good.
So going into October, is there anything that you're going to focus in on, like one particular economic data point? Or
our breadth numbers, which we always talk about, have gotten a little weaker than we would like to see after the Fed cut rates. It's a little market adjusting, a little seasonality there on certain aspects. Not seeing a major negative divergence yet, but we need to see it get rehabilitated a little bit. So if especially on the bond side, if that gets weaker over the next 2 or 3 weeks, that will become more of a concern. But we're still seeing a lot of liquidity out there and things moving in orderly fashion. We're past the worst of seasonality, and we're coming into a good part of the calendar as far as post-election years go. So October may be a little bit more sluggish, as history shows, after being so strong, but I have to assume that the general market will continue to improve. And now that we're past, quote unquote, the weaker part, now that the Fed is becoming more accommodative and more dovish, I would assume that things will start to broaden out a bit. Not saying that consumer staples will become leaders and every healthcare stock will go back to where it was 3 years ago, but we should see stronger overall participation. And really, that's all we can ask for after the last couple of years that we've had. It'd be nice to let some of these other areas of the market do the heavy lifting. We know that's not going to happen because the big tech names make up too much of the S&P 500. But because of how much the economy has, I think we're looking at like 3.8% GDP for next quarter. The economy has firmed up. It will be good to get some of those other areas to become leaders for a while. So I expect it to be good.
If the data changes, we'll let everybody know.
Nothing crazy in October probably, but the strength will be there. And again, the average return when we're this strong through September usually is 4.5% through the rest of the year, which a lot of people will take. So.
Yeah. Well, it's a good month to, if you have money on the sidelines or you got defensive earlier because you were nervous about the stock market or the tariffs. It's a great time to plan and maybe just start dollar cost averaging some of that money in and look for areas that have underperformed. And hey, nothing wrong with adding to some of the ones that have outperformed either because they seem to keep going up as well. But good time to reevaluate and make sure you're positioned for in a pretty positive looking fourth quarter that we're entering here. So that's how we're going to approach it.
We got 6 months to work through here. And I really believe after the next 6 months, the strength of the consumer is really going to help drive this market and really drive the economy much further. Right. And the market should follow.
Well, thanks, Brad. We will keep you posted. Thanks for joining us on the October edition of View from the Ranch, and we will see you next month. Thank you very much, and God bless.